If you don't have a retirement income strategy, you don't have a retirement plan, period. You can have $1 million saved, you can have the nicest financial advisor in the world, but if you don't have a plan for where your income is coming from, when you'll access it, and how it's taxed, you're flying blind. And the reality is, that's how most retirees are living. They spend their working lives building their savings, and then when retirement hits, they realize no one taught them how to spend it down strategically. That's why today we're talking about the exact strategy the wealthy use to turn their savings into predictable, tax-smart, and long-lasting income. It's called the 3-bucket strategy. And once you understand how it works, you'll never look at your retirement accounts the same way again. If you're new here, my name is Mark Wisniewski, and I'm the president of Southern Income. I help retirees and near retirees build tax-efficient retirement plans that prioritize one thing above all else: income that you can rely on. Here's the truth. Retirement isn't about how much you saved, it's about how you structure what you save. And most people think, I've got my 401k and my IRA and some savings, I should be fine, right? But when you actually get into retirement, the question shifts from how much do you have to where should I pull from first, or how do I make this last without overpaying in taxes? That's where so many people get stuck. They don't have a withdrawal plan. They don't have a tax strategy, and they're often just guessing which account to draw from each year. What happens then? Well, they either underspend out of fear or they overspend and outlive their money. And here's the thing, the wealthy don't leave this to chance. They build structure into their income plan. And one of the simplest, most effective frameworks they used is called the 3-bucket strategy. This approach helps you weather market volatility without any panic. It reduces your taxes in retirement. It creates a stable income stream that covers your lifestyle. You grow your money over time without sacrificing peace of mind. And the best part, anyone can implement this. Whether you've saved $500,000 or $5 million or more, this framework gives you the retirement dollars with a purpose, so that you're not guessing your way through one of the most important financial transitions of your life. In this video, I'll break down exactly how the 3-bucket strategy works, how the wealthy apply it to preserve and to grow their income, and importantly, how you can start aligning your own retirement money around this strategy, starting today. Bucket number 1, the safety bucket. Let's start with the safety bucket because this is the one that gives retirees the confidence to actually enjoy retirement. The safety bucket holds the money that's meant to be stable and liquid and easily accessible. This is where you pull from when the market's down, or when the roof needs replacing, or when you just want to sleep well at night knowing that you're covered for the next 12 to 24 months. Here's what goes into this bucket. Naturally, cash and high-yield savings accounts or money market funds, short-term CDs, treasury bills or ultra-short-term bonds. Think of it as your emergency fund plus your income bridge. Why does this matter so much? Because sequence of return risk is real. If you're pulling money from your growth investments when the market's down, especially early in retirement, you can accidentally lock in losses that your portfolio may never recover from. That's how retirees with a solid nest egg run out of money. It's not because they didn't save enough, it's because they didn't have a system in place for when and where to pull from. The wealthy avoid this by using the safety bucket as it's kind of like a shock absorber. Let's say that the market drops 15% this year. Instead of selling stocks at a loss, they simply pull from this bucket while the rest of the portfolio recovers. No panic, no bad timing, and no unnecessary taxes. Now, one thing I want to make clear, this bucket is not about earning high returns. It's not about growing your money. It's about preserving what you need right now. And that's where a lot of retirees go wrong. They either keep too much in cash and lose purchasing power to inflation, or they keep too little and they're forced to sell long-term assets at the worst time. We want balance. The rule of thumb I use with clients is keep 12 to up to 24 months of income needs in your safety bucket based on what you actually spend in retirement, not just your gross income. So if you spend $6,000 per month, you might keep between $72,000 and $144,000 in this bucket. This gives you flexibility, it gives you control, and it's the foundation for your other buckets to grow over time without unnecessary risk. Bucket number 2, the income bucket. Now, let's move into the income bucket. This is where your steady steady, predictable income comes from. While the safety bucket is designed to give you short-term peace of mind, the income bucket is what it covers your monthly expenses over the medium term, anywhere from 5 to 10 years or even longer. This bucket includes investments that are designed to generate consistent cash flow with less volatility than the stock market. Here's what that might look like. It's dividend-paying stocks, it's bond ladders, municipal bonds, especially for tax efficiency, fixed or fixed-indexed annuities, rental income, REITs, or real estate investment trusts. The key here is reliability. When you're in retirement, you're no longer in accumulation mode, you're in distribution mode, which means your focus needs to shift from how much can this grow to how much can this generate consistently. Let's say you need $5,000 a month to live comfortably and Social Security might cover $3,000. That's a $2,000 gap. That should come from your income bucket, not from selling stocks, not from dipping into your emergency fund, but from investments specifically selected to produce income. Now, here's where smart planning comes in, especially when it comes to taxes. If you generate $20,000 a year in interest or dividends from a taxable brokerage account, that income is likely taxed every single year, whether you need it or not. But if those same income-producing assets are held in a tax-deferred or a tax-free account like an IRA or a Roth IRA, you could control the timing and the amount of taxes that you actually owe. That's exactly how high net worth retirees structure their income. They match the right income-generating investments to the right types of accounts. They minimize tax drag and maximize cash flow. So here's a quick example. Let's say you've got a bond ladder producing $25,000 a year. If it's held in a taxable account, that $25,000 is taxed as ordinary income. But if it's in a Roth IRA, that same $25,000, zero federal income tax. And if it's in a traditional IRA, you can at least control when and how much of your distributions are being put out to avoid pushing yourself into higher tax brackets. That's the real power of the income bucket. It's not just about creating income, it's about creating income that's intentional and reliable and of course tax smart. This bucket gives you the freedom to let your growth bucket work harder and longer without you needing to tap into it when the market's down. Bucket number 3, the growth bucket. Last but absolutely not least is the growth bucket. This is the long-term engine of your retirement plan. It's where you place assets that are meant to grow over time and not provide immediate income. Let's define what belongs in this bucket. Well, as you might imagine, stocks and stock-based mutual funds or ETFs, growth-oriented index funds, Roth IRAs and Roth 401ks, taxable brokerage accounts with low turnover, and of course alternative investments or even private equity for some high net worth investors. But here's the key. This money should be money that you don't need to touch for at least 10 years. That's why it can afford to ride out the ups and downs of the market, because the biggest risks to a retiree aren't just taxes and healthcare, they're longevity risk. That's what outliving your money. Inflation. Your dollar's purchasing power over time is constantly shrinking, and the growth bucket fights both of these. And here's why the wealthy love this bucket. They know that if they're taken care of with their short-term needs, their safety bucket, and their midterm cash flow, their income bucket, they can let this money work harder, smarter over time. And if structured right, this bucket can be the most tax-efficient part of their entire plan. Here's how. 1. Roth IRA. Roth accounts grow completely tax-free. If you convert part of your traditional IRA to a Roth early in retirement while you're in a lower tax bracket, you can then let those Roth dollars sit and grow for decades. And when you take distributions later, it's all tax-free. Even better, your heirs can inherit a Roth IRA and withdraw the money over 10 years with no income tax owed. 2. Tax-efficient brokerage accounts. Even if you're using taxable accounts, long-term capital gains are taxed more favorably than ordinary income. And with proper tax loss harvesting, asset allocation, and low turnover strategies, you can minimize that annual tax drag while growing the account for legacy and late-stage retirement needs. Let me give you a quick example. Let's say John and Karen are both 65. Their safety and income buckets are fully funded, and they've got $400K in a Roth IRA and another $300K in a low-cost stock index fund in a brokerage account. They don't plan to touch the growth bucket until they're in their mid-70s at least. By that time they get there, it could be worth $1 million or more, and they've bought themselves time, tax efficiency, and of course, flexibility. And that's the power of this final bucket. It allows your money to compound over time. It gives you options later in life for long-term care, legacy, or even spending in your 80s and into your 90s. And most importantly, it keeps you from becoming too conservative too soon. Because here's the trap. Too many retirees move all their money into safe investments the second that they retire. But retirement could last 25, 30 years or more. And if your money isn't growing, it's shrinking. And the growth bucket is how you make sure that doesn't happen. So let's recap. The 3-bucket strategy is not about picking the hottest investments. It's about creating clarity and control and confidence in your retirement income plan. Your safety bucket protects you from panic and market downturn. Your income bucket funds your lifestyle with predictable cash flow. And your growth bucket, well, that ensures that you don't run out of money later in life. And it helps you leave a meaningful legacy. The wealthy have been using this strategy for decades, not because it's flashy, but because it works. And the good news is you don't have to be wealthy to use it. You just need a plan that aligns your assets with your timeline, your tax strategy, and your goals. That's what we do every day at Southern Income. If you're within 5 to 10 years of retirement and you want help building a retirement income strategy that's tax smart, sustainable, and stress-free, click the link below and book a free call with my team. We'll walk you through your current buckets, whether you realize you have them or not, and help you build a plan that actually works for your life. Thanks for watching. I'm Mark Wisniewski, and we'll see you in the next one.